Welcome to Chapter 2. In this PowerPoint series, we're going to look at the basic accounts, look at how debits and credits impact the accounts. We're going to look at the recording process, and that's really what we're learning is basic accounting. We're going to look at some manual processes. Obviously, in the real world, everything's computerized, and we don't do things quite this way. But to understand the theory behind accounting, we'll take a look at it this way. We'll look at a lot of examples of how we post and journalize activities, and then we'll look at a trial balance. A trial balance is really a tool that helps us detect errors, make sure we've got things in place, that we haven't missed items. The account, basic account. And we gave examples of accounts in the last chapter, but cash and accounts receivable and accounts payable and owner's equity would all be examples of accounts. And the left side of an account is the debit side. The right side of an account is the credit side. Students have asked me over the years, where did they come up with debits and credits? And sometimes I go on this long elaborate story I make up about the early days of accounting. Actually, I don't think anyone has a real good idea of why they call things debits or credits. I was on a sailboat recently, and they called things port and starboard instead of left and right. So just different terminology for different fields. But don't make rocket science out of this. Write it down. Keep it handy. Look it up. The trick is not to remember whether the left side is a debit or a credit. The trick is to be able to do accounting. T accounts, the bottom of the screen here shows a T account with the left hand side being debit, obviously the right hand side being credit. Double entry accounting, each transaction must affect two or more accounts to keep the basic accounting equation balanced. Recording is done by debiting at least one account and crediting another. Debits must equal credits. You remember from the first chapter that the 11th commandment was assets must equal liabilities plus owner's equity. Well, in this chapter we're learning the 12th commandment. Debits must equal credits. You keep those two things in mind. You don't violate those commandments. You keep all your accounting rolling right along, and so you can't make mistakes. This is another interesting part. If debits are greater than credits, then the account has a debit balance. If credits are greater than debits, then the account has a credit balance. And most asset accounts and expense accounts have a debit balance. That means the debits are larger than the credits. Now, it's not always the case. Sometimes, for example, if we spend more cash than we have, we go into an overdraw thing, and there our credits would actually be larger. But most of the time, for asset accounts, the debits are larger than credits. In this transaction, we've got a debit of $10,000. We've got another debit of $8,000. So we've got total debits of 18, and then we have a credit of 3. So if we net those out, the 18 minus the 3 gives us 15. And since our debits are larger than our credits, that means it's a debit balance. A debit balance of 15. In this transaction, or this account, we have a debit balance of 10,000. We have a credit, we don't have a debit balance, we have a debit entry of 10,000. We have a credit entry of 3,000, a credit entry of 11,000. So our debits are 11, our debits are 10, our credits are 11,000. So we have a $1,000 credit balance. We net out the debits and credits. So here's the normal account balances. Assets and expenses normally have a debit, and accounts that normally have a credit would be liabilities, owner's equity, and revenue. So a basic balance sheet includes assets, liabilities, and equity. And then the income statement is the revenue minus expenses. And you'll remember that these two, the revenue expenses, fold into equity. So that debits increase assets, debits increase expenses. But if you debit a liability or an equity or revenue account, then it's a decrease. And credits do just the opposite. So obviously, if you learn what debits do, if you just focus on one, you say, okay, debits increase assets, then we know that debits increase expenses, and debits do the opposite to liabilities, equity, and revenue. And then we can figure out credits are just the opposite. So it's really just a matter of focusing on one thing, learning it, and then extrapolating it to everything else. So I caution students, don't get all bogged down in this making a mystery out of debits and credits. They're really not that mysterious. So a review question, debits A, increase both assets and liabilities, and we know that's not true. It increases assets, it does not increase liabilities. And B, that answer would be wrong as well because it doesn't decrease assets. Debits for item C, increase assets and decrease liabilities. That's starting to look like a pretty good choice. And choice D, decrease assets, that's not true. Increase liabilities, that part's true. So I'm going to go with C here. Let's hope I'm right. Discussion item here, Maria Alvarez, a beginning accounting student, believes debit balances are favorable and credit balances are unfavorable. Is Maria correct? Sometimes students want to attach value judgments to things like debits and credits, and they're just terminology. It's just like left and right. There's nothing correct about left or right. There's nothing favorable, unfavorable about debit or credit balances. It depends on the account. We want our asset accounts to have debit balances. That would be favorable. But we want our liability accounts to have credit balances. We want owner's equity to have credit balance. That would be favorable. So I suppose if there's a bias toward it, it's that normal account balances are favorable. So again, kind of summarize this. For assets, debit should equal credits. For liabilities, credit should exceed the debits. And the normal balance is on the increase side. Owner's equity and revenues, they increase owner's equity with credits, while owner's drawing account and expenses decrease owner's equity by debiting those. Remember, owner's drawing is when the owner takes something out of the business that he's going to use for personal use, or she's going to use for personal use. The purpose of revenue, a purpose of earning revenue is to benefit the owners. The effects of debits and credits on revenue account is the same as their effect on owner's capital. And expenses have the opposite effect. Expenses decrease owner's equity. Another review item here, accounts that normally have debit balances are assets, expenses, and revenues. That's not true because revenues don't have a debit balance. Assets, expenses, and owner's capital, that's not true because owner's capital doesn't have a debit balance normally. Assets, liabilities, and owner's drawing, that's not correct because liabilities don't have a debit balance. So I'm starting to look like choice D is a good answer. Assets, owner's drawing, and expenses. They all normally have debit balances. Relationship among the assets, liabilities, and owner's equity of a business. We're showing assets equal liabilities plus owner's equity, and then we're grouping the drawing, revenue, and expenses in that under that umbrella of owner's equity. Transaction must be in balance after every, the equation must be in balance after every transaction. And the basic equation, remember, the 11th commandment. And then we also have the 12th commandment: for every debit there must be a credit. Recording process. We analyze the transaction, we enter it in a journal, and then we're going to post from the journal to ledger. Business documents. Most things have some sort of document of origination: a sales slip, a check, bill, a cash register tape. There's something that triggers this. Seldom will it be a handshake. The journal is the what they call the book of original entry. It's where we record things in the first place. As we move on in accounting, we're going to see some different journals. Be a sales journal, a purchases journal. But for this chapter and the next chapter, we're just going to look at the general journal. Transactions get recorded in chronological order. They get recorded in date order. So that transactions happen first, get recorded, the next transaction gets recorded. So it's all done in date order. The contributions recording process, it discloses the complete effects of a transaction, provides a chronological record, and helps to prevent or locate errors because we can do some quick comparisons. So journalizing is the process we call entering a transaction into journal. And the example that's going to come up here is on September 1st, Ray Neal invested $15,000 cash in the business. That's one transaction. The second transaction is that SoftBite, his company, purchased computer equipment for $7,000 cash. So on September 1st, we debit cash for $15,000, and we credit R. Neal Capital for $15,000. And at the same time, we bought some computer equipment. So we're going to debit computer equipment, and we're going to credit cash because we use cash to buy the equipment. So notice that the debits equal to credits here. Another transaction, assume that on July 1, Butler Company purchased a delivery truck costing $14,000. It pays $8,000 cash now and is going to pay the balance, the remaining $6,000 later. So it's going to debit delivery equipment for $14,000, and it's going to have two credits. One credit for the cash of $8,000 and another credit to accounts payable for $6,000. Again, debits equal credits. 14,000 debit, two credits total 14,000. The general ledger, the general journal, was where we just recorded those transactions. Now we're going to post them into the general ledger. And the general ledger is a list of all of the accounts of a business. Includes the assets, liabilities, owner's equity, revenue, expense accounts. In our textbook, we use a T account form, which is just a basic simple T to analyze left and right debits and credits. In the real world, account forms are a little more structured. My first year of accounting, I was in Chicago and having lunch with a group of us having lunch with a partner in a big time accounting firm, and we were discussing something, and he whipped out a notepad and started using T accounts to analyze things. And I'd always liked using T accounts, and if I ever felt uncomfortable about it, he squashed that feeling. Cause here's this guy making $1 zillion, and he was pretty happy using T accounts to help him analyze things. So don't feel uncomfortable using T accounts. So posting is the process of transferring amounts from the journal to the ledger, from the general journal to the general ledger. Item 1 here is we took to cash that debit of 15,000 and we put a debit in the general ledger cash account. And item 2, we entered a debit account number in the journal reference column. This process of moving things from not moving them, but of posting them from a journal to a ledger involves a cross-referencing component, so that we don't, when we post something in the general ledger, in the reference column there we indicate where it came from. In this case it was J1 or journal page 1. And back in the journal page under the reference column we post the account number 101 to indicate where we posted it. In theory, if you don't post these, you don't do the cross-referencing piece until you've actually done the posting. Sometimes people will short-circuit this and just kind of start posting and not keep track of the cross-referencing, and that's an easy way to overlook an item. So cross-referencing, X-referencing is the process of recording the source of the entry and the account number, be it in the general journal or general ledger. So another review question. Posting normally occurs before journalizing. That's not true, because we're going to post after we journalize. Transfer ledger transaction data to the journal. That's not true. Is an optional step in the recording process. That's not true. And I'm starting to look choice D here. Transfers journal entries to ledger accounts. So again, we're posting from a journal to a ledger, so choice D is a winner. The chart of accounts is a listing by account number in sequence, so that with Pioneer Advertising Agency here, all of the asset accounts start with a digit 1, so that cash is 101, accounts receivables 112, and so on. Liability accounts all have a 2 in their starting digit. So notes payables 200, accounts payables 201. Owner's equity has 300s. Revenue accounts would have something in the 400s, and expenses have something in this case 6, 700s, and 900s. Different businesses use different chart of accounts and numbering systems, but this one would not be unusual. So here's a summary of the recording process. We get a transaction. In this case, it's on October 1, C.R. Boyd invests $10,000 cash in an advertising company called Pioneer Advertising Agency. We determine what type of account is involved. So our basic analysis here tells us that cash is involved and owner's equity is involved. Excuse me. We want to determine what items increased or decreased and by how much. So cash, the business now has $10,000 in cash, so that would be an increase. And C.R. Bird now has $10,000 in his equity account, so that would be an increase. And then we do the debit and credit analysis. So we're going to debit cash by 10. We're going to credit owner's equity by 10. Again, keeping debits equal credits. And then we come up with the journal entry, and then we actually post it. So in this transaction, on October 1, Pioneer purchases office equipment costing $3,000, and it does it by signing a 3-month, 12% $5,000 note payable. The 12% there means that's the interest rate. It's an annual interest rate. It's not 12% a month. It's not 12% every 6 months or 3 months. It's 12% per year, and it's a $5,000 note payable. So our basic analysis is that we now have an asset, office equipment, that increased by $5,000, and we have a liability account, notes payable, that increased by $5,000. So our journal entry down here is to debit office equipment for $5,000 and to credit notes payable for $5,000. In this example, on October 1st, Pioneer purchases office equipment costing $5,000 by signing a 3-month, 12% $5,000 note payable. So they didn't spend cash today. Instead, they gave a promise to pay a note payable of $5,000. I want to point out here, kind of a learning moment, that this 12% interest rate, that's an annual rate. It's not a monthly rate. It's not a 3-month rate. It's an annual rate. Interest rates are always given an annual time period. So later on, we'll figure out interest, see what the interest expense was, because there's usually an interest expense on a note payable. But the basic analysis is that the asset, office equipment, increased by $5,000, and our liability account, notes payable, increased by $5,000. So if we look down here at the journal entry on October 1st, we have a debit to office equipment, a credit to notes payable. We then post that. Another transaction here on October 2nd, Pioneer receives a $1,200 cash advance from R. Knox, a client, for advertising services that are expected to be completed by December 31st. So on October 2nd, our company, Pioneer, enters into an agreement with Knox to do some services for him, advertising. He in turn, or she in turn, gives us $1,200 in cash, and we agree to provide some services. So our basic analysis here is that we have, obviously we have cash, that's an asset account, that increased by $1,200. The credit side of this activity is a little more interesting, because we're getting in on October 2nd. We haven't done anything to earn the revenue yet. We haven't performed the account of the advertising services yet. So we're going to credit an account called unearned revenue. Later on, when December 31st is here, and if we've actually done the work, we're going to be able to move it from unearned revenue into revenue. But for today, on October 2nd, we're going to put it in unearned revenue. So our journal entry down at the bottom here is a debit to cash, $1,200, and a credit to unearned revenue of $1,200. On October 3rd, Pioneer pays office rent for October in cash of $900. So we debit rent expense for $900 and credit cash for $900. Since this is all taking place, this is October, we're in October and it's October's rent, we're just going to go ahead and put it in the expense account now. If we're in October and we paid our rent for November, then we might put it in some kind of a prepaid asset account and not put it in the expense account yet. But since this is October, We're paying October's rent. We're going to go ahead and expense it now with debit to expense and credit to cash. On October 4th, Pioneer pays $600 for a 1-year insurance policy that will expire next year on September 30th. So remember, I just said that since we're doing the rent just for 1 month and it's the current month, we'd expense it. This prepaid insurance is a little different because that's going to cover a 1-year time period. So in this case, we're going to debit prepaid insurance for $600 and credit cash for $600. And as time goes along, we're going to make adjusting journal entries and take amounts out of prepaid insurance and move it to insurance expense. As time goes by and we get the benefit of that insurance coverage, we'll do that. October 5th, Pioneer purchased an estimated 3-month supply of advertising materials on account from Arrow Supply for $2,500. So we're going to debit advertising supplies, which would be an asset, and we're going to credit liabilities for $2,500. So it would be an accounts payable. Again, if this $2,500 was in things we were going to consume, use up in October, we would have put them into supplies expense. But since they're more of a line of a prepaid item, we're going to put them into advertising supplies, and eventually we will transfer them to expense. Here's an event that doesn't get recorded. On October 9th, Pioneer hires 4 employees to begin work on October 15th. Each employee receives a weekly salary, $500, blah, blah, blah. But nothing happened on October 9th that needs to be recorded. They didn't actually do any work. We promised to pay them if they work, so it's all contingent there. We don't need to record that. On October 20th, the owner, C.R. Bird, withdraws $500 cash for his personal use. That's going to decrease cash, obviously, so that will be a credit to cash of $500. And we're going to make an offsetting debit entry to a drawing account of $500. And just to reinforce this a little bit, drawing serves to reduce the total owner's equity. On October 26th, Pioneer owes the employee salaries of $4,000 that we talked about a slide ago and pays them in cash. So we're going to pay them in cash. That's going to decrease cash, so we're going to credit cash by $4,000, and we're going to debit salary expense for $4,000. You know, if cash is involved in a transaction, it makes the analysis much easier, at least from my perspective, because I know if I'm going to spend cash, it'll be a credit to cash. If I'm receiving cash, it'll be a debit to cash. And once I know one side of a transaction, the other gets easier to figure out. October 31st, Pioneer receives $10,000 in cash from Copa Company for advertising services provided in October. So I receive cash. I'm going to debit cash for $10,000. I'm going to credit service revenue for $10,000. So after we've done all the journalizing and posting and the cross-referencing that we do while we're posting, we then go and prepare a trial balance. We look at each account in the general ledger and figure out what the current balance is, and we list it. So here we're listing all of our debits and credits. And fortunately for us, the debits total $28,700 and the credits total $28,700. That gives us some confidence that things are okay. An emphasis on some confidence. It doesn't mean it's perfect, it doesn't mean it's correct, but at least things balance so that our debits equal credits part of the commandment was in place. But I said some confidence, so these are the limitations. It's possible that we didn't journalize something. We might have even cross-referenced it but never got around to journalizing it. So a correct journal entry is not posted. Or it's possible we post something twice. We receive cash for 10,000 advertising services. Maybe we made a mistake and recorded that twice. You can also use incorrect accounts, and you can also make offsetting errors. So ideally, if you've done everything right, this will balance out. But don't. It can give you some false confidence. So trial balance review question here. Trial balance will not balance if a correct journal entry is posted twice. Actually, it will balance if it's posted twice. The purchase of supplies on account is debited and credited to cash. That would still keep our trial balance okay. It wouldn't be a correct entry because we should have credited it to accounts payable, not to cash. Item C, a $100 cash draw by the owner is debited to owner drawing for $1,000 and credited to cash for $100. That should not balance. That should throw off to trial balance because debits don't equal credits there. And the last one, a $450 payment on account is debited to accounts payable for $45 and credited to cash for $45. Since with debits equal credits there of $45, that will keep things in balance. Obviously, it's wrong. It should have been $450. So choice C is the correct answer. So that's a wrap up of chapter 2. Hopefully the PowerPoint here and the little lecture supplements all the great reading that you're doing. Study hard, tackle the problems, let me know.